Investing in emerging markets, is now the right time to invest? Have you ever wondered what it would be like to invest in markets that are rapidly evolving but come with a higher level of risk? Emerging markets, countries and regions that are in the process of industrialization and growth, offer a promising, yet challenging, environment for investors. As the global economy shifts, many investors are turning their attention to these markets, hoping to capitalize on opportunities that could lead to significant financial gains. But with great opportunity comes great risk. So, the question arises, is now the right time to invest in emerging markets? Understanding emerging markets are nations or regions that are not yet fully developed but are experiencing rapid economic growth. These countries often have a growing middle class, expanding industries, and a shift toward more liberalized economic policies. They typically offer higher growth rates compared to developed markets like the US or Europe, but they also come with higher volatility and political risks. Countries like China, India, Brazil, and South Africa are well-known emerging markets, but the landscape is much broader. Southeast Asia, parts of Africa, and Latin America are home to emerging economies with vast potential for growth. Why are emerging markets attractive to investors? 1. High growth potential. Emerging markets often experience rapid economic growth, driven by factors such as urbanization, industrialization, and expanding technology infrastructure. 1. For example, China's rise as a global economic power has been fueled by its shift from a primarily agrarian economy to an industrial powerhouse. 2. Growing middle class. As economies develop, a middle class emerges with increased purchasing power. 2. This shift is happening in countries like India and Indonesia, where millions of people are moving out of poverty and into the middle income bracket. 2. A growing consumer base means more demand for products and services, which can lead to higher profits for companies operating in these regions. 3. Diversification. Investing in emerging markets allows investors to diversify their portfolios beyond developed markets, reducing their exposure to any single economy. 3. Diversification is key in reducing investment risk and capitalizing on growth in different regions. 4. Demographic advantage. Many emerging markets have young, growing populations, which can be a long-term driver of economic growth. 4. For instance, Africa has the youngest population in the world, with a median age of just 19 years. 4. This demographic trend means a rising labor force, expanding consumer demand, and an increase in productivity as younger generations enter the workforce. 5. High returns. Historically, emerging markets have outperformed developed markets in terms of growth. 5. For example, between 2000 and 2010, emerging market stocks returned an average of 11.5% per year, compared to just 1.6% per year for developed market stocks. 5. While these returns come with higher risks, they can be appealing to investors willing to ride the waves of volatility. Risks of investing in emerging markets. 1. Political instability. Many emerging markets face political instability, which can create significant risks for investors. 1. Changes in government, policy shifts, and social unrest can impact the economy and markets. 1. For example, Venezuela's recent economic collapse has been attributed to a combination of political mismanagement and falling oil prices. 2. Currency risk. Emerging markets are often subject to volatile currencies, which can impact the value of investments. 2. A sharp decline in a country's currency can erode returns for foreign investors. 2. For instance, the Brazilian real has fluctuated wildly over the past decade, reflecting the political and economic uncertainty in the country. 3. Regulatory and legal risks. In many emerging markets, regulations and laws may be less developed or enforced, leading to potential challenges for investors. 3. The lack of transparency in financial reporting and the risk of corruption in government and businesses can make it difficult to assess investment opportunities accurately. 4. Economic volatility. Emerging markets are more susceptible to global economic shocks. 4. A drop in global commodity prices, shifts in trade policies, or natural disasters can have a disproportionate impact on emerging economies, which are often more dependent on exports and foreign investment. Key sectors to invest in. 1. Technology. The tech industry is booming in emerging markets, especially in countries like India and China. 1. The growth of e-commerce, fintech, and mobile technology offers immense investment opportunities. 1. Companies like Alibaba, Tencent, and Flipkart are prime examples of tech giants that have capitalized on emerging market growth. 2. Consumer goods. As middle classes grow, so does the demand for consumer goods, ranging from electronics to household products. 2. Multinational companies are looking to emerging markets to fuel their next wave of growth. 2. Companies like Unilever and Nestlé are increasingly focusing their attention on these regions. 3. Infrastructure. Emerging markets are investing heavily in infrastructure to support their growing economies. 3. This includes everything from roads and railways to energy production and telecommunications. 3. Infrastructure funds can be a good way for investors to gain exposure to these markets. 4. Renewable energy. As the world shifts towards sustainability, emerging markets are beginning to invest in renewable energy sources. 4. Countries like India and Brazil are already large players in the solar and wind energy sectors, presenting opportunities for green investments. Emerging markets in 2024. What does the future hold? Looking ahead, the outlook for emerging markets remains positive, albeit with challenges. The global economy is shifting, and emerging markets are increasingly becoming the growth engines of the world. For instance, India is poised to become the world's third largest economy by 2027, thanks to its young population and technological advancements. Meanwhile, Africa's emerging markets, such as Nigeria and Kenya, continue to attract foreign investment as they urbanize and modernize their infrastructure. However, investors should remain cautious. Global factors such as interest rate changes in developed markets, commodity price fluctuations, and geopolitical risks can have significant effects on emerging market performance. As such, careful research, risk management, and diversification will be critical for investors seeking to capitalize on the growth potential of these regions. Conclusion: is now the right time to invest in emerging markets? The answer to the question, is now the right time to invest in emerging markets? Depends on your individual investment goals, risk tolerance, and time horizon. While diversifying your portfolio, staying informed about local economic conditions, and focusing on key growth sectors, you can take advantage of the high return potential in these regions. Emerging markets are not without their challenges, but with proper strategy and due diligence, investing in these regions could potentially yield significant rewards. Whether you're looking to diversify your portfolio or take advantage of booming industries, the key to success in emerging markets lies in balancing risk and opportunity. So, the next time you ask yourself whether now is the right time to invest, remember that the answer could very well lie in the rapidly changing economies of the emerging world.